focus on metals. I mean, we've seen a downtrend ever since the start of December, stroke the end of November, when commodities saw their peak levels on the London Metal Exchange. What does the road ahead look like for the metals universe? Joining us to discuss this in detail is Bhavesh Chauhan. He's research analyst at IDBI Capital, and also David Lennox, resource analyst at Fat Profits. David, let's start with you. I mean, the last time we spoke to you, you said that of all the commodities in the commodity complex, you're most bullish on crude at this point. And post that, we've seen a marginal shave off from peak levels on base metals on the LME. I mean, be it the end of November or the 5th of December, when recently most of these metals, including copper and aluminium, scaled their recent highs. David, is my voice reaching you?
Yes, it is.
Yeah. So my question. Yeah. My question to you was that the last time we spoke to you, you said that you're positive on crude out of the entire commodities complex. After that, since the end of November or the beginning of December, we've seen all commodities come off their recent highs by around a quantum of 7% to 5 or 10 odd percent each. Apart from the exception of crude, which is charting a course of its own, does that view continue to remain?
Look, certainly when we have a look at the broader commodities complex, we have seen somewhat of a rest in the pricing, and that is because over the last month we've seen quite an escalation in the price. So one would expect, as we run into the Christmas period, that we would perhaps see some slowing down in that demand, and we would see the prices just pulling back. And really, that's what we think is happening at the moment, because as we look into 2017, we do think that the reasons for the prices rallying so hard, and that is the Donald Trump infrastructure statement, that will certainly be implemented through 2017. On the crude, it in fact is now starting to gain market momentum, that the implementation of the agreement that was made to cut the production to 32.5 million barrels will in fact be able to be complied with by the broader OPEC group and those non-OPEC members who agreed to participate. So markets are really now starting to become a little more confident that that's going to happen. So of course, at the moment, we're in that honeymoon period where implementation isn't quite in place. That will occur on the 1st of January. So the market's just looking to that hope and driving those crude prices just slowly higher as we run into the end of this year.
Right. Bhavesh, comment on the domestic scenario as far as steel prices are concerned. We've seen a strong support led by the minimum import price, substitution by anti-dumping duty, and even global resilience in terms of steel prices. But having said that, we've also seen a very strong, a period of very strong up move in coking coal, hard and soft coking coal, and also in terms of iron ore, we've seen a very strong rally. There has been some bit of a price up move that has come through, but do you think that more is required to hedge off or to offset that margin erosion that can come through possibly in the second half earnings?
Yeah, absolutely. What we have seen is that iron ore prices and even more importantly, coking coal prices have risen sharply. In fact, coking coal prices were trading around $100 in July, and now they are up to $240. They have come off their highs of $300. But the cost push that is happening on account of higher coking coal prices, steel makers need a lot more hike than what is happening. So we have seen last couple of months, we have seen steel price rose by close to 3,000 to 4,000 rupees, and now they are mulling an hike of close to 5,000 rupees again. But the cost push from the coking coal alone is around 12 to 13,000 rupees. So, you know, on a EBITDA per ton basis, given the weak demand that is pertaining in India, we do not expect steel makers to be able to pass on the full price hike in the coming quarters. And these two are seasonally very good quarters, actually, Q3 and Q4. So, that is how things are panning out in the steel sector.
Right. David, comment on this. I mean, domestically, we've seen our steel companies benefit a lot because of the trend of strong steel prices globally. But as you also know very well, that coking coal has seen a very sharp surge, I mean, ruling over $300 per ton compared to something like an 80 or 90, and this up move happened only within a period of 1 or 2 months. And most of the coking coal is imported in India because we have very few captive reserves of coking coal, I mean, natural resource-wise. Apart from that, there's iron ore, which has rallied, so domestic producers and miners in India have also hiked their prices in consonance with that. So steel margins are, shrinking until and unless a very big price up move comes through to compensate for it. What's your view on both, on Australian coking coal as well as global iron ore?
Well, look, certainly you've got the score right there in terms of the coking coal. We have seen that significant rise, and that has been on the back of the fact that globally the steel industry, which was forecast to actually, I guess, retreat through 2016, actually hasn't retreated. We've seen it actually put on modest growth. So when you put that into context with, again, what we think will happen in 2017, we really did see those markets rally away quite strongly. And it will again fall to what will happen in the US. If we see that infrastructure program come into being, then there's going to be a requirement for steel inside the US. And that's really, we think, going to create a second pressure point. We've seen it coming out of China over the last couple of years. If we see it in the US, then that's really why we've seen these prices adjusting, and adjusting quite highly to the top side.
Right. Bhavesh, comment on the non-ferrous universe. We've seen companies like Hindalco, Nalco shave off quite a bit in yesterday's session. While I understand that you might be constrained to talk about stock-specific action, but for the industry overall, what you see the trends in terms of alumina and aluminium separately. Bauxite as a resource is crunched in India. The government is making efforts to ease up more resources in the east, and commentary from Vedanta suggests so. But in terms of aluminium, we've seen some bit of a cooling off since the peak in the early period of December. I mean, we're down 3% since 23rd November. But overall, and even the MECON has recommended a lower MIP on aluminium. So the concerns there start becoming real in context of the fact that LME starts to decline, and you have lesser of support in terms of the MIP on aluminium.
See, in terms of aluminum, we see the global cost of production is close to around $1,400, $1,500, and today it is trading around $1,700. So there is not much gap for the aluminum price to go down. Although we do not expect a sharp rally in aluminum going forward, but we believe that aluminum prices are likely to remain stable, and downside is limited compared to other metals like zinc, which has risen very sharply. And also, actually, we do not have coverage on Nalco or Hindalco, so won't be able to comment on that. But we feel that stable aluminum prices are expected to give a fillip to a company called Rain Industries, whose end demand comes from aluminum. So we have recently initiated coverage on it, and it is an ideal way to play aluminum. So we have a buy rating on Rain Industries.
That's an interesting call coming there, Bhavesh. I'll come to you, David, and speak to us specifically about nickel, because Bhavesh just spoke about raw material costs. Here we have got obviously stainless steel manufacturers, some listed and some otherwise, who have benefited a lot from the kind of fall that we saw in nickel prices. We've seen that up move start to happen in nickel, but again, I mean, ever since the 5th of December, nickel has cooled off very sharply, almost 8% on the LME. So what do you make of this? And also on back of the news flow, as far as the Environment Ministry in Philippines is concerned, there was a buzz that 20 more bigger mines might be shut down, so there might be some supply shrinkage.
Yes, and I think, again, you've really hit the nail on the head. The Philippines has, in fact, taken action to close mines in the past on environmental grounds. So that really does mean if they do flag that there could be potentially further mine closures, then it's more than likely that that's what's going to happen. So the market has been building that in over some months, and we did see that strong rally in the nickel price. Again, it was certainly fully supported by the Donald Trump infrastructure statement. So you've got those two very strong tailwinds that push nickel up to quite good heights. We have seen both of those factors now cooling a little bit, and as you said, we've seen nickel prices falling, and really that's a natural reaction that we would expect given those strong prices that we have seen. We do expect that perhaps we will see some further closures inside the Philippines. As I said, they've done it before. And of course, with the Donald Trump infrastructure program, well, we've got to wait until after the 20th of January and really just see how far he can push this program to how much of a real impact it will have on the nickel price come 2017.
Right. Bhavesh, what do you have to say about copper and aluminium both, and the business risks or otherwise, because we've seen the treating and refining charges for copper, which is obviously a key monitorable for more copper exposed companies. For instance, Hindalco and Vedanta obviously come top of the mind first. So refining margins and smelter margins are very important in this context. So what's your view there going ahead in terms of earnings stability? Because we've seen some up move, spot premium in aluminium. I mean, the worst, I think, is behind us. Do you think that that category in terms of margins is likely to remain stable for both copper and aluminium from here on?
See, as far as copper refining treatment charges are concerned, we do not track that as of now. So I do not have a concrete view on it. But as far as alumina goes, I think we have seen a sharp rally, which has also led to a rally in Nalco. Now Nalco is more exposed to alumina than aluminum, and hence we over the last 1 year we have seen an up move in Nalco from probably 30 levels to over 60 levels. Going forward, also we expect alumina price to remain stable rather than decline. As far as aluminum goes, I have already given my view that we do not expect a downside because cost of production will come in to support aluminum prices at lower levels. So we see a case of stable aluminum prices going forward.
Right. David, coming on zinc, I mean, we've spoken in the past about the prospective mine closures that are about to come up. Scorpion and Lisheen are obviously two of the bigger ones. But, we spoke to the Vedanta management almost a month and a half back, and the management there was of the view that, while there is some supply shrinkage, but they're also investing in the Gamsberg mine in South Africa. So while some bigger mines are ending their mine life, but there are some other ones which are also coming on stream at this point. But do you see overall the supply-demand balance to even out, or do you expect supply shrinkage to continue from here on? And also, given the kind of strong rally that zinc has seen, is there greater scope for a correction?
Look, certainly you'd have to suggest that with that strong rally that we've seen in the zinc price, we would expect to see capital now actually flowing into more projects getting started, more brownfield operations looking to start back up. So we do think that there will be some more of a challenge in 2017 for the zinc price than we saw in 2016, but that supply demand is still in deficit. We think that certainly zinc will remain that way now for some time, probably for the next couple of years until we really do see some of those projects starting to kick in from the brownfield side. So overall, zinc is probably one of the more confident metals that we're looking at going forward into 2017 in terms of price rises. It is in deficit now. Some of the others, such as copper and nickel, we think at this point certainly aren't in deficit. They remain in surplus, and that will just keep those headwinds against any significant rise. Zinc, however, it's in deficit, so we could see it higher, but not as high as we think it ran in 2016, but it will be firmer.
Right. Bhavesh, on the fundamentals of zinc, I mean, without, commenting on company-specific issues, but Hindustan Zinc has been a really stable performer as far as even EBITDA is concerned. And we are seeing, as in the Rampura Agucha mine, the underground expansion is also happening. But the margins there, the scope for that keeps on increasing. So there is stability in terms of margins for zinc players going ahead from here on?
Yeah, absolutely. There will be stability as far as at least Hindustan Zinc is concerned, because we've seen a very sharp rally in zinc price, and as you said that it is come on because of supply shrinkage. One of the largest mines is closed down. Having said that, Hindustan Zinc price also rallied very sharply, so we do not foresee a case of stock giving very good returns from these levels. So probably wouldn't recommend investing in Hindustan Zinc as of now.
Right. David, let's come back to crude. What's your target for crude for the year end from here on? Do you see a stable, sustained move? And crude remaining in this range of broadly 54 to 55 as far as Brent is concerned, the spread between WTI and Brent, and Asian refiners, specifically Indian refiners, have been big beneficiaries of importing discounted crude from Saudi, Iran, Iraq, as well as North Africa. Do you think that discount trend is likely to continue even after this agreement has been struck?
Well, look, certainly the agreement's been struck. What we have to look for now is from the 1st of January, we have to see how compliance will be. And in the past, you'd have to suggest that OPEC has been terrible at complying with its own agreements. But this time they've got outside countries involved as well. So it may be a little different. Look, in 2017, we do expect to see Brent trading up a little higher. We don't think it'll run significantly high or hard. We're looking at an end of year or trading up into and perhaps finishing the year at around $68 to $77 a barrel. When we're looking at West Texas, we think it'll finish between $65 a barrel and $75 a barrel. So the margin between the two, we think, will remain fairly stable. There will be times of volatility in there, but there are certain headwinds such as the inventory numbers. And of course, depending on what US production does in 2017, we expect it to kick up, so that's why we're not calling the oil price up to $100. We're suggesting that it'll only stay in about the $68 to $77 range for 2017.